Hi, this is Steve Eisman, and welcome to another edition of the Weekly Wrap. One can say a lot of things about President Trump, but one thing is a certainty. He does not make things dull. And the last 2 weeks reinforced something I've said before. The markets are trading headlines and focusing almost solely on headlines regarding, you guessed it, tariffs. Last week, the S&P 500 index was down 2.7%. Why? Tariffs. President Trump announced that negotiations with the European Union were going poorly. So he would be raising tariffs on the EU from 10% to 25% starting June 2nd. Also, he announced that he was seriously contemplating putting on a 25% tariff on Apple because Apple manufactures everything in China. Going back to the Apple news, as far as I can tell, there has never been a tariff directed solely at one company. If the Apple tariff goes through, Apple will have that dubious and unfortunate distinction. One more point about Apple. If you want to know the pickle Apple is in, you can listen to my recent podcast interview with Patrick McGee, who just published a new book called Apple in China. His conclusion is that Apple is stuck in China for the foreseeable future. It manufactures everything there and would take years to create another manufacturing ecosystem outside China. So Apple is captive to any tension between the United States and China. Back to the weekly wrap. But first, the stats. This week, the S&P went up by 1.9% and NASDAQ increased by 2%. So it wasn't a bad week. But the big news of the week occurred late Wednesday. The U.S. Court for International Trade unanimously ruled in a 3-judge panel that almost all of President Trump's tariffs that were imposed through, this is a little bit of a word salad, the International Emergency Economic Powers Act, otherwise known as the IEEPA, were illegal. If, and it's a big if, this ruling stands, then $220 billion of tariffs go out the window and only $40 billion of tariffs remain. Tariffs that were declared illegal are the 10% universal tariff, the reciprocal tariff rates, and tariffs imposed on China, Canada, and Mexico. Sectoral tariffs for steel, auto, and pharmaceuticals and semiconductors remain. The court ordered that tariff collections end within 10 days and, get this, refunds be sent out. Needless to say, the markets rallied on this news, but then faded as investors began to realize that the tariff story is far from over. By the end of the day of Thursday, the Federal Circuit Court of Appeals issued a temporary stay of the order, so for now, the tariffs stay in place. The stay is temporary, and if the Federal Circuit upholds the opinion of the Court of International Trade, the case will, without almost complete certainty, go to the Supreme Court. It'll probably go to the Supreme Court regardless of what the Federal Circuit decides. But here is a crucial point. President Trump has the authority to reimpose tariffs, and he will do so, just under different legal authority. According to one report I read, Section 338 of the 1930 Tariff Act allows for reciprocal tariffs if a country treats U.S. companies poorly and allows for tariffs of up to 50%. Since all the reciprocal tariffs were set below 50%, and this must have been intentional, all President Trump has to do under Section 338 is wait 30 days, and he can then reimpose the tariffs. No need to get more into the weeds than I already have, but there are other laws that combined with Section 338 would allow President Trump to reimpose almost all of the current tariffs. This game is not over, not by a long shot. One other point on the appeals process. This case is being appealed to the Federal Circuit, which sits in D.C. There, Trump should probably get a lot more deference than the trade court he just lost at. The U.S. Court of Appeals for the Federal Circuit has a history of being deferential to presidents, or so I am told. However, there are going to be ripple effects from this case. It's going to make trade negotiations harder, and the July 9th deadline that President Trump gave Europe may not stand. And just to show that the tariff story is far, far, far from over, on Friday, President Trump accused China of violating an agreement with the U.S. to ease tariffs. What that violation was, he didn't say. But Secretary of the Treasury Bessent made a kind of similar statement that the negotiations were stuck. And now, earnings. This is the tail end of earnings season. Only 14 companies in the S&P 500 reported this week, and next week only 7 will report. But there were some important results. On Wednesday, 3 retailers reported: Macy's, Dick's Sporting Goods, and Abercrombie & Fitch. Macy's quarterly results were fine, but it cut its 2025 EPS outlook because of tariffs and economic uncertainty. Dick's Sporting Goods, on the other hand, also reported fine numbers, but they actually maintained their 2025 guidance. Abercrombie & Fitch beat consensus for the quarter, but they also reduced their full-year guidance for the same reasons. But despite the cut for Abercrombie & Fitch's guidance, the stock opened up 25%. Why? Now, I'm not 100% sure, but I could take a pretty educated guess. It's probably because the short interest was quite high. 14% of the float was short. So maybe too many people were short, and the stock did not go down on the print. And the stock is not exactly liquid, and so hedge funds covered in a panic. I flagged these 3 companies not because they provide much insight into the consumer. Most retailers don't matter that much to the market or the economy. Here's why. Macy's has a market cap of $3.4 billion. Dick's Sporting Goods has a market cap of $14 billion. And Abercrombie has a market cap of $4.5 billion. By contrast, Amazon's market cap is $2.2 trillion. Amazon matters, and these 3 companies really don't. And speaking of Amazon, there was important news over the last few weeks and months that matter in the retail world. 6 years ago, Nike pulled its merchandise from Amazon. It tried to reach the consumer through various direct-to-consumer strategies, none of which really succeeded. And last Wednesday, it threw in the towel and went back to Amazon. This follows Estee Lauder and Saks Fifth Avenue, both of whom now sell through Amazon. The message here is very clear. When it comes to the consumer, Amazon is king. There were some important tech results as well. Salesforce reported. The company reported a pretty good quarter, beating on both earnings and revenue, and it also raised its earnings and revenue guidance. And yet, the stock did not go up. It was flattened after hours and down at the open on Thursday. Why? Well, one firm, Royal Bank of Canada, downgraded the stock to sector perform from outperform. But maybe something deeper is going on. Until the last few years, software stocks consistently outperformed hardware. Over many years, software companies transformed their business models from quarterly sales to what's called a SaaS model, software as a service. And here's an important lesson. Never, ever underestimate the importance of an Excel spreadsheet on valuations. Modeling a company with quarterly sales revenue is notoriously difficult, but a SaaS model is much easier to model and much more consistent. As the customer base grows, so does the earnings. So software has consistently sold at higher multiples and outperformed hardware. And hardware is always a quarterly sales model. But with the advent of NVIDIA's new chips and AI, hardware has mostly outperformed because of the explosion in hardware sales. But there might be something else that the market is sniffing out. AI reduces costs to create software by quite a lot. And so the moats around software business models might be eroding. So investors are beginning to worry that AI could hurt the established software companies. Maybe some of that is starting to creep into Salesforce's stock. And then there's NVIDIA. The world held its breath on NVIDIA's earnings announcement, but the results were truly great. It beat on earnings and revenue. Sometimes things with NVIDIA move so fast it's hard to grasp. But think of this. The company reported quarterly revenue of $44 billion. That was up 12% versus the fourth quarter, but up 69% versus the quarter a year ago. Think about that. A company with $44 billion in quarterly earnings and a market cap in excess of $3 trillion grew revenue by 69%. I'd conclude from this that it's still very early in the AI story. And finally, Dell gave a profit outlook that exceeded estimates. On the positive side, AR server orders were strong at 12 billion and backlog was 14 billion. But the quarter itself was not great. The company missed earnings because of weak margins. The stock was up about 1% after hours because of the increase in the company's guidance. And that's the weekly wrap. On Monday, we will drop another episode of our podcast. My guest is Rahul Jindal, the fintech strategist at Autonomous. It was a great conversation. We started out discussing crypto and Bitcoin. We then moved on to stablecoin and discussed whether stablecoins will ever play a major role in the payment system. And we also discussed the payment system in general and payment stocks. See you next week for another episode of The Weekly Wrap.